Okay, let's talk about how a company can lower its tax bill. You know, one of the most powerful, but honestly most misunderstood tools in their toolbox is something called capital allowances. Yeah, I know, it sounds a little bit like boring financial jargon, but stick with me, because we're about to unpack exactly how this thing works and why it gives businesses such a major leg up.
So just imagine this for a second. A company goes out and drops millions on a shiny new factory, or maybe a whole fleet of new cars. That is a massive expense, right? So can they just write off that entire cost against this year's profit and, slash their tax bill to almost nothing? It seems logical, but the answer is a big fat no. The system works in a totally different way, and getting your head around that difference is really the key to understanding modern business finance.
So here's our roadmap for today. First, we'll look at a company's big buys. Then, we'll dive into this slow deduction rule that's so important. After that, we got to talk about how to account for old assets before we can even think about adding in the new stuff. And finally, we'll tie it all together and see why this all really matters.
Now, to make all this a bit more real, let's invent a company. We'll call it Manufacturing PLC. And let's just say they've had a very busy year, making some huge investments to really grow their business.
And listen, we're not talking about buying paper clips and coffee for the break room here. No, these were huge long-term investments. You know, the kind of assets that are going to be the backbone of the company, making them money for years, maybe even decades. Let's put some numbers on it. They bought a new industrial building for $5 million, some new plant and machinery for $1.75 million, and a whole fleet of new vehicles for $3.5 million. Now, in the world of tax, these are what you'd call qualifying capital expenditures, and the rules for these are completely different than for your everyday running costs. So if a company can't just deduct that entire $10 million plus bill all at once, what do? Well, this brings us right to the core idea we're talking about today. A system of slow, steady deductions, which is officially known as capital allowances.
The easiest way to think of capital allowance is like the government's version of depreciation. It's basically a system that lets a business write off a little piece of an asset's cost each year. And that kind of mirrors reality, right? Because things like buildings and machines, they wear out, they get old, they lose value over their useful life.
Now, this whole system basically has two main tools. First up is the initial allowance. Think of this as a big one-time bonus you get in the very first year you buy a brand new asset. It's awesome. Then you have the annual allowance. This is the smaller, more standard deduction you claim every single year to account for that wear and tear on all your assets, both the old ones and the new ones.
Okay, so to figure out the total allowance for the year, we can't just jump straight to the shiny new stuff they bought. The whole process actually starts with what the company already had on its books at the very beginning of the financial year.
So on day one of the year, this is what the company's asset portfolio looked like, at least from a tax point of view. They had buildings with a remaining tax value of $10 million, machinery sitting at $2 million, and a pool of vehicles valued at $3 million. That's our starting point. But of course, things are never that static, are they? Businesses are always changing. So during the year, our company sold off one of its older vehicles. This is a really crucial step in our calculation because we have to account for anything that's been sold or disposed of.
And to do that, we need this thing called its tax written down value, or TWDV for short. It's just a fancy way of saying the asset's remaining value on the tax books, after you've subtracted all the deductions from previous years. It's basically what the tax office thinks that asset is still worth.
So, for this one specific vehicle they sold, after you track all the allowances it's had over its life, you find out its final tax written down value at the moment it was sold was $375,000. And here's the key step. That $375,000 has to be subtracted from the total motor vehicle pool. I mean, the logic is super simple, right? You can't keep claiming a tax deduction for something you don't even own anymore. You have to take out the old before you can bring in the new.
Okay, so we've tidied up the books and dealt with the old assets. Now it's time for the really exciting part, bringing those massive new purchases into our calculation.
And this is where our two types of allowances come back into play. First, the company gets to claim that big one-time initial allowance bonus on all its new stuff. Then, after that's done, it calculates the standard annual allowance on the remaining value of its entire asset base. That includes both the old and the new.
And just look at the power of that initial bonus. Wow, just for buying new assets, the company gets an immediate tax deduction of over $3.3 million. And you'll notice the biggest piece of that pie comes from the new vehicles. They get a really generous 50% initial allowance rate, which is a pretty clear government incentive to get companies to upgrade their fleets.
But we're not done yet. After that huge upfront bonus, the next step is to calculate that standard annual allowance for wear and tear. And this is calculated on the remaining value of all the assets, so the existing ones plus whatever is left of the new ones after their big initial bonus has been deducted.
So, let's recap. We've accounted for the old assets, we've added the new ones, and we've calculated both the initial and the annual allowances. Now it's time to put all those pieces together and see the final number, and more importantly, understand the real-world impact of it all.
And there it is. After adding up the initial allowances on the new assets and the annual allowances on everything else, the total capital allowance for our company this year comes to a massive $8.94 million.
Now, this right here is the most important part to get. The company doesn't get a check in the mail for nearly $9 million. That's not how it works. Instead, it gets to deduct that amount from its profits before the tax is calculated. And of course, lower taxable profit means a smaller tax bill, and that frees up critical cash that they can then reinvest back into the business.
And this really gets to the big picture, you know? Why do we even have these complicated rules in the first place? Well, because they're a really powerful economic tool. They make huge investments more manageable for businesses. They reflect the reality that assets wear out. And maybe most importantly, they act as a direct government incentive for companies to invest, to modernize, and to expand. And all of that is the fuel for economic growth.
So we'll leave you with this question to chew on. We've just seen how one single tax rule can directly encourage a company to spend millions on new equipment. So what other behaviors, from hiring more people to adopting green technology, can be influenced, for better or for worse, simply by the way we write our tax code? It just goes to show you, taxes aren't just about raising money. They're about shaping the future.